Hey gang, Anthony Fontana here. We're live after 5. Just wanted to do a really quick PSA. It's Sunday night, so I'm not going to do any major training tonight. I actually have a number of things to do and a webinar to do myself in just a little while. This is a PSA in connection with what I'm seeing in real time using my professional software, my tax accounting software, with regard to refunds. I think a lot of people are going to have some issues with their own accountants, and they're going to think, oh, this accountant sucks, let me find another one. It's going to happen. I'm already seeing a lot of feedback online from different accountants that I know, tax preparers that I know, various people. Hey, Philip, what's going on, brother? So I want to address it real quick because I'm seeing it in real time. Like I had a brand new client today. I ran into Levittown to pick up some paperwork from a couple of people, a couple of family members, not my family, family members of friends of ours, and first time I've ever met them. And son and a mom. And when I'm looking at the mom's paperwork, last year she said, well, you know, she got several $1,000 refund. Well, last year she was also a head of household, and last year was 2017. So when I'm looking at very quickly, I can do things very quickly in my head. I'm looking at her W-2, and I noticed that the withholding was substantially less than what she had last year. And the challenge that she'll have is she'll still get a refund, but it might not be that big. You know, maybe $1,000. In fact, I've already done the return. It is about $1,000. Well, here's the thing. The tax code changed a number of things. One of the things that changed was the withholding, because the tax rates have gone down. So withholding slowed down. Now, if you didn't make any adjustments with your own your withholding form W-4, then what's going to happen is you're going to have less taken out of your paycheck. You're going to make more money, less taken out. You're going to be taking home more money. So you might have noticed an increase in your take-home pay. It might not have been huge, depending on how much you make, or it could have been pretty significant. Either way, you changed nothing. Your income tax withholding went down. Your take-home pay went up. So now here's the challenge. A lot of people that depend on refunds, and I've never been one to depend on a refund, when you're looking at that refund coming in, you're thinking it's going to be big. I'm preparing for it. I call it a forced savings. Frankly, I don't agree with the whole idea the government should keep my money until I get it back sometime in April or May, but that's just me. Understand this. When you sit down with an accountant this year, be it someone else, me, whoever, what's going to happen is they're going to be looking at your return, and there's going to be a number of things that they can no longer do. You union guys, for example, you can no longer deduct anything as it relates to the cost of doing the work that you do. I think that's patently unfair. It's the one thing I disagree, the two things I disagree with the tax law change. Very significant, because a lot of union guys, carpenters, for example, police officers, firemen, corrections officers, my daughter's a corrections officer, these people, they spend money on guns, uniforms, all this other stuff in order to make the money that they make. It's kind of like they own a business and they're spending some money to earn the income in the business. The problem I have is they're being penalized for having just a job, not a business. A corrections officer isn't a business, it's a job. Yet the $3,000 or $4,000 that's spent maintaining the job cannot be recouped in any shape, manner, or form on a tax form now. It just can't be done. That's just unfortunate. Another big hit is there's a cap on SALT, state and local income tax. So what's happening with that is huge, especially if you're in New York, where we pay big bucks on Long Island for our real estate taxes and, of course, income taxes. It's capped at $10,000. Anyone that owns a home anywhere in the tri-state area of Long Island, California, Michigan, a lot of states, they're limiting that to $10,000. So you might have a $9,000 tax bill. Get excited, but then you have a $4,000 withholding tax with state, or $3,000. You are now over the cap. Last year it was fine, you got it all. This year you no longer do. You can no longer take any casualty loss. Hurricane Sandy came through and knocked your house down. Tough luck. You can't claim any of that right now. Hold on, I got a connection request here. So basically, those are two major changes. There is no longer a what's called a 2106 unreimbursable employee expense, cannot be deducted anymore, and we're capping the taxes that you're allowed to deduct on your returns. Now, one good thing, if you have big medical bills or insurance that you're paying for your family and medical bills on top of it, co-pays or whatever, That has been dropped from 10% of your overall adjusted gross income to 7.5%. It used to be 7.5% and it went up a few years ago. Now it's been brought right back down to 7.5%. So if you have insurance that you're paying for, you're going to see an increase in that particular deduction if it's over 7.5% of your income. So if you're making $100,000 a year, anything above $7,500 is going to be deductible, including the miles to get to and from the doctor. So a few things like that are tweaking the returns. I'm seeing it live. I'm doing returns every single day as they come in, and every one of them are off from where they were last year as a group. It's just the way it is. Now, I'm encouraging my friends that have little businesses to either incorporate those puppies, get that done, and start grinding that business out and develop that secondary or tertiary income because you're going to need it, or just do it because it just makes more sense to run things through a business if you're self-employed. You're able to deduct pretty much everything on a self-employment document, right? So that's just the way it is. So bottom line is going to be this. Don't kill your accountant when you go see him. Don't choke him. Don't say, what are you doing? You're a moron. There's only so much he can do. He's going to be limited by what the software is allowing him to do. Now, if you're doing your own, or if an accountant's doing it, I want you to look out for one big thing. Currently, this is the last year for it, thank God. The Obamacare, they call it not a tax, a penalty. Yeah, well, it's a penalty, it's a tax. I've had clients come in making less than $80,000 a year with a child, a head of household, last year paid a $1,500 penalty. That's insane to me. They paid because they couldn't afford the insurance. So I had a client come to me, went to another accountant last year. She came to me this year as a brand new accountant. But last year, I saw her return. It said $1,570 penalty. I'm like, well, you got this penalty list here. Did your accountant explain to you how it's calculated? She said, no. It's just he gave me back the return. I called it a day. I'm like, you didn't have insurance last year? She said, no, I couldn't afford it. Did your accountant know you couldn't afford it? And she said, well, he didn't ask. I just couldn't afford it. So he checked off no form, and that was the end of that. I'm like, what's your insurance on your job? Oh, it's $780 a month. So I whipped out my calculator, which is not here. Oh, here it is. I'll do it right now. $80,000 a year income at 8.15% is $6,020 a year. That means in her case, anything above $543, well, you can't see it's upside down, anything above $543 a month for any kind of healthcare insurance is considered unaffordable if you choose not to get it. I have amended that return right away. That return has already been amended. It's already back to IRS. She's going to get a check in the mail for $1,570 in about 8 weeks for the last year return. All right, so I did that pro bono just because I wanted to. So she's getting a refund back, and I noticed that on a number of other returns, people that are getting hit with those penalties. So if you're doing the returns yourself, if you're using TurboTax or anything online, make sure you're indicating, if you don't have insurance, if it is in fact unaffordable. How do you figure out if it's unaffordable? You get your employer to tell you what you figure out what it is with your company, what the monthly bill would be, either single or with dependent, whatever it is, family, whatever it is. And then you multiply your own gross income by 8.15%. And if it's above that, if the company figure is above that figure, it's deemed unaffordable. You're allowed to take that exemption. Now, here's the thing. There's a special way to do it on software. Software is tricky. I got to be honest with you. It's a little tricky. Now, this is the last year you'll have to worry about it. And I'm kind of hoping that if you're listening to this, send this to anybody that you know. It's great. If you want to look at some resources on the subject or on anything related to your own personal taxes, go to my site, anthonyfontana.tax, T-A-X. It's .tax. It's my site. It's my name, .tax at the end of it. Go there, check it out. There's a lot of resources. There's a newsletter. It's all free. Go check it out. Go find out if you need something there. If you need any help from me, please ask me. But don't kill your accountant. I don't want to see the maiming of accountants over the next 4 weeks because a lot of guys never bother to explain this stuff to to their own clients last year because we knew it was going to happen, and I did explain it. None of my clients care. They were all aware of the situation. So anyway, love you guys. Have a great night. Ahmed, I know I got to talk to you later. Without question, brother, it's complicated. No doubt about that. Just the fact that I've read the code up and down for years doesn't mean I understand it. No one understands it. I love you guys. Have a great night. Enjoy. Share this if you can. Love it.